What percentage of stocks and what percentage of bonds should you have in your investment portfolio? That's the question we're going to be tackling in this video. But first, let's quickly go over what a stock is and what a bond is. Stocks are shares of a company that represent partial ownership. If you own one stock of Starbucks, then you are a partial owner of Starbucks. Bonds are a loan by a government or corporation. These entities give out money with a predetermined interest rate that will be paid in full by a set date. There are two main things that you as an investor should really care about: the rate of return or the growth of a stock or bond over a period of time, and the volatility or the fluctuation in price. Owning stock is like hiking a mountain. Sometimes you have to hike up a steep incline, sometimes you walk on level ground, and sometimes you even travel down a bit. Stocks are a bumpy ride, but if you hold on, you will end up at a much higher place financially. Bonds, on the other hand, is like walking up a steady hill. It's not as steep as a mountain and the drops aren't as heavy. It's a simple pace upwards. At the end of the day, over a long period of time, stocks grow at a faster rate than bonds, but bonds don't experience the fluctuations that you'll see in stock prices. Based on historical data, the stock market averages about 10% of growth every year, and bonds average about 5% of growth every single year. Of course, these are averages. One year, stocks could rise up 20%, and the next year it could drop 10%. There are two stages in your financial life. There's the wealth accumulation phase, and then there's the wealth preservation phase. The wealth accumulation phase is the period in your life where you are building up a massive nest egg that you can eventually retire on. The wealth preservation phase is when you reach a point where you don't really care about making more money, but are more concerned about preserving the value of your dollars. So why would you want to have both stocks and bonds? The main reason is to prevent loss. Stocks are extremely volatile and may drop 50% over the course of a month. At the same time, bonds may actually be up 10%. This is a good reason why you shouldn't have all of your money in one basket. It may be wise to have the majority of your money in the stocks basket to be your main moneymaker, and then to have some of your money in the bonds basket to help combat the volatility of stocks. Another huge reason why you should have both stocks and bonds is that when you are actively drawing from your investments to live off of, you don't want to be caught in a situation where the stock market tanks 40% and you have to sell some of your stocks at that loss just to fund your lifestyle. When a stock market crash happens, you will see the value of your investment portfolio tank. But these are just losses on paper. They aren't real. They only become real when you actually sell your stocks. However, if you are living off of your investments to fund your life, you have no choice but to sell your investments at this loss, making it real. This is why bonds are so crucial in the later stages of your life, because you are able to withdraw money from your bonds in the case of a stock market crash. So what's a good stock bond allocation? Keep in mind that I'm not a financial advisor, so make sure you do your own due diligence before making any financial decisions. Everyone's financial situation and goals are different, but this is my approach to the stock bond allocation. The general rule of thumb for the stock bond allocation is that the percentage of stocks you should have in your portfolio is 100 minus your age. So if you are 60 years old, you should have 40% in stocks and 60% in bonds. Likewise, if you are 30 years old, you should have 70% in stocks and then 30% in bonds. Though this rule of thumb has been challenged in recent years, mainly because people don't believe it's aggressive enough and the life expectancy of people have been much higher. You may want to bump up your stock percentage. You could use 120 instead of 100. So if you're 30 years old, 120 minus 30 is 90, so you should have 90% of stocks, and only 10% of bonds. Again, this is just a general thumb and assumes you're retiring at the typical age of mid-60s. I, for one, believe that people should choose their stock bond allocation based on the number of years until they plan to withdraw from their investments. If you're over 10 years from drawing from your investments, you have a long time horizon. This is the case for me, and this is the reason why I have 100% in stocks and 0% in bonds. I can stomach the stock market drops, and I want my money to grow faster in the stock market than it would with bonds. 40% drop in the stock market? That's fine by me, because I know I'm not going to sell my stocks and make those losses real. I know over time it'll bounce back and reach new highs. There have been numerous stock market crashes, and every single time the stock market bounces back and continues to grow. If you have 10 or fewer years from when you are going to be withdrawing from your investments, then you want to start adding bonds. The very simple way to do this is to invest your money in a target date fund or a life cycle fund. These are funds designed specifically for people retiring by a certain date, and they handle the stock bond allocation for you. Vanguard has numerous target date funds spanning every 5 years and is one of the best deals you can get due to their low fees. These are Vanguard's rough stock bond allocations based on the number of years you have till retirement. For individuals over 25 years from retirement, Vanguard's target date funds have around 10% of bonds. Going down when people are just entering retirement, Vanguard has them at 43% of bonds, and when you are a few years into retirement, Vanguard bumps that up to about 60% in bonds and only 40% in stocks. As of right now, my plan is to be a bit more aggressive, and when I am 10 years from retirement, I'll only have 10% of bonds and 90% stocks, and when I'm 5 years from retirement, I'll have 20% bonds and 80% stocks, and then when I'm actually in retirement withdrawing from my investments, I'll have 40% bonds and 60% stocks. And this is the stock bond allocation that I plan to reach when I'm in that wealth preservation phase. No matter who you ask, the general consensus is to increase your bond percentage as you age. I ran a simulation of how well my 60% stocks and 40% bond investment portfolio would fund my retirement. And using a 4% rule of withdrawing 4% of my portfolio every single year to fund my life, there is a really high probability that the value of my nest egg won't even decrease. This is because the stocks and bonds in my portfolio grow at a faster rate than I'm withdrawing. So I'm actually slightly increasing the amount of money I have. Vanguard also did a study using historical data on the rate of returns of different stock bond allocations. Over the span of 1926 to 2019, here are the average annual returns of different stock bond allocations. For 100% bonds and 0% stocks, it averaged 5.33%. For 90% bonds and 10% stocks, it averaged about 5.99%, with the best year in 1982 with a rate of return of 32.62%, and the worst year in 1969 with a negative 8.13%. 14 of the 94 years were losing years, so the portfolio lost in value. Going up to a 100% stock and 0% bond allocation, it returned an average of 10.29% every single year, with the best year in 1933 with a 54.2%, worst year with a negative 43.13%, and having 26 losing years out of all 94 years. So you can see that stocks on average have a higher rate of return, but way more volatility than bonds. Everything so far has been mostly talking about using broad, low-cost index funds such as the S&P 500 and the bond market. But what about individual stocks? What percentage of your portfolio should you invest in companies that you love and truly believe will grow? Investing in individual stocks is what gets people excited. This is how I got started in investing, and it's quite a rush. However, investing in individual stocks is riskier than going with a broad low-cost index fund such as VTI or the Total US Stock Market Index. This is because individual stocks are a lot more volatile. You're putting all of your eggs into one company rather than a span of 3,000 companies. The percent of individual stocks that you should have in your investment portfolio really depends on your risk tolerance. If you are 10, 20 years from your retirement, then you might be comfortable with having 20% or even 30% of your portfolio in individual stocks. If you are a lot less risk tolerant, then you could have about 5 or 10% in individual stocks. What'll probably end up happening with your individual investments is that you'll experience extreme gains and very sharp losses. And over the long term, you will actually have subpar gains than the total US stock market. Your baseline isn't 0% growth. You should not be happy if you buy a stock for $100 and then over 10 years it's still $100. The baseline you should be comparing everything with is a broad diversified index fund such as the S&P 500. If you're YOLOing all your money on a handful of companies, then be prepared with the stress and possibly heart attack that comes with that. If you're investing in over 20 individual companies in various sectors of the stock market, then you start to benefit from the risk reduction that comes with diversifying your investments. When should you rebalance? Whatever rebalancing plan you have, stick with it. One popular one is just to rebalance your portfolio once a year. So say you have a 60% stock and 40% stock bond allocation. Every year you should rebalance your portfolio to reflect that. With this, you actually benefit from selling high and buying low. Say stocks are at all-time highs and the 60-40 stock bond allocation becomes 70-30. So when you rebalance, you are selling a percentage of your stocks at those high prices and buying more of the bonds at lower prices. Rebalancing is totally up to you. You may decide that it's just not worth your time to rebalance, and this certainly is a valid reason not to rebalance. Rebalancing really only makes a difference when you have a large amount of money. In the end, if you have an investment plan, stick with it, no matter what the market looks like. Keeping human emotions out of investing is the best way to guarantee your financial success. It's people's fears that cause them to make mistakes and damage their gains. If you found this information helpful, please give this video a like because it really helps support me in this channel. Subscribe for more videos on personal finance, minimalism, and of course, investing. Peace.